Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining for our Friday Insights edition. Today is September 16th of 2022, and we're going to take a little bit deeper look, historically speaking, of bear markets. You know, we're in a technical bear market right now, and the definition is when markets, let's say the S&P in this case, is down by 20% or greater. And we hit that in June earlier this year. And as markets are basically turbulent and volatile and chopping around, as we're looking for direction from the Federal Reserve, as we're looking for direction from corporations and earnings, we have to chop through the volatility of the marketplace. And when you're in a bear market, there is a playbook. There is a, hey, light at the end of the tunnel. It's usually not a train, but we can look at the past experiences. In fact, since 1926, we have a chart here for you, and I'll walk you through it. But since 1926, if we look at the S&P 500, we've had 11 previous bear markets. In fact, this is the 12th right now by that definition. Now, keep in mind, we're looking at the S&P only, but the Dow and the NASDAQ have actually, the NASDAQ's down close to 30% at the low earlier this year. So let's go to the board here. Since 1926, if we're looking at the S&P 500, there have been 11 previous bear markets. Again, today is the 12th. By definition, the S&P is down by 20% or greater earlier this year. And in the 11 previous bear markets, going back in time, it's a 20% or greater, a lot more. Some markets were down way more than 20, in fact, even double than that. The average decline, if we take those last 11 bear markets and average them together, we saw an average decline of about 38%. Okay, so that's bear markets come and they come very quick, very fast, and they actually come with a maximum drawdown sometimes of close to 40%. We're halfway there right now, as of today, and the average duration right now, if you look at previously, they're not as long as a bull market. Bull markets can be 5 to 7 years in length, and then the bear markets are a lot shorter. So the average of the last 11 bear markets is just 1.2 years, or just over a year and a couple of months. Right now, we're at the 7-month mark. Okay, so we're not quite at the average, but it doesn't mean that we have to go to 1.2 years. It doesn't mean we have to go down 40% to actually hit there, historically speaking, because there's some bear markets that are a little bit better than that in terms of average duration and drawdown. Now, what happens with the bear market? Why we say, hey, listen, let's stay balanced, let's stay invested in terms of the long run. Let's understand that we own quality and we own corporations that actually will get stronger when they go through recessions, when they go through the outside, sort of the other side of the bear market, simply because it's just the nature of competition. If a recession hits America, a lot of other companies can't hang or hold on. And so they close up shop. So the big get bigger, and actually they have, let's say, lean and mean maybe for a year and a half. But on the other side, the market opportunity is even greater because their competitors were wiped out. And that's how the larger get larger, and we own large caps, we own quality, we own management teams that actually take advantage and they lean into recessions, not quite by, let's say, earning or by hiring, but by, let's say, cost management and mitigation. They maximize the balance sheet. They'll bring in technology, which then adds to a greater multiple moving forward. So what does that mean, Rob? Well, a year later, the average of the previous 11 bear market declines going back to 1926, as measured by the S&P, the average 1 year later bounce back was 48%, over 48%. And then if we're 2 year later, after we go through the bear market, you had a 69, close to 70% return. So that's why listen, at the end of the day, we're diversified, we're balanced. We win by not losing, by maximizing our risk management on the downside. That's why we have balanced portfolios. So we're not going down as much as, let's say, the respective S&P 500, and that's our goal. That's what we try to do in terms of the downside protection. Therefore, when markets then turn their tide, as they always do at some point in time, then we can then start taking advantage of the upside. So the averages are in our favor. The history is in our favor. So as we're in a bear market, it's always great to take time out and look at the historical perspective. So thanks for watching. I hope you learned something. If you have any questions, please give us a call at Blanke Schein Wealth Management, and enjoy the rest of your day and your weekend. Take care.